So I'd like to introduce our next speaker, Roger Ibbotson. Roger Ibbotson is chairman and CIO of Zebra Capital Management, an equity investment and hedge fund manager. He is founder and advisor and former chairman of Ibbotson Associates, now a Morningstar company. Professor Ibbotson conducts research on a broad range of financial topics, including liquidity, investment returns, mutual funds, international markets, portfolio management, and valuation. He has recently published The Equity Risk Premium and Lifetime Financial Advice. He also co-authored 2 books with Gary Brinson, Global Investing and Investment Markets. He's a regular contributor and editorial board member to both trade and academic journals. He received his bachelor's degree in mathematics from Purdue University, his MBA from Indiana University, and his PhD from the University of Chicago, where he taught for more than 10 years and served as the executive director of the Center for Research in Security Prices. Please welcome Roger Ibbotson.
Thank you. That's me. And this is our topic here today. So I guess, wait, I got to turn this on. Okay. All right, so this is, our topic is the ABCs of hedge funds. So you can see we're not going to be doing anything difficult here today. The whole purpose is to make this straightforward and simple. And of course, once you get the ABCs, you have to find 3 things to match the A's and the B's and the C's. And for me here, it's alphas, betas, and costs. So yeah, as I am a, you can see, yes, I am actually a manager of a hedge fund and actually long-only products as well, Zebra Capital, about $500 million. We're not that big compared to, of course, some of the players in the industry, but we're trying, I guess, getting going here. We've been before that though. I had been running a company, Ibbotson Associates, which was more on the asset allocation side, and so I've got a lot of research actually on asset allocation as well. The asset allocation research, I still do that. I'm an advisor to Morningstar. Morningstar bought Ibbotson Associates in 2006. All this time, though, I've been a professor at Yale, and it's been a great avenue for all the research and a great synergistic experience. I guess there's not that many professors who actually are business people, but I guess I've tried to do both here over my life. All right, let's get on with the talk here. All right, starting out, and I think the pickup on the video is more on this side. So I don't mean to say to short anybody over in that side of the room, but we've got 2 screens here. However, this one is the one with the video on it. All right, so starting out, we're going to be talking about measuring hedge fund returns. And one of the big problems we're going to have in measuring hedge fund returns is the data can be very biased. It says, is the data biased? The answer is yes. You can still stay for the rest of the talk. I mean, there's more than that to it. Then we'll look at the sources of the returns and how we can split them into alphas and betas and their costs. And then we'll see how hedge funds can mix with stocks and bonds. So hedge funds are a big industry nowadays. You can see how they've grown since 2000 here. Well, I've got 3 things up there in this graph. The orange line is the number of hedge funds, which is on the right-hand side. There's about 8,000 hedge funds out there today. This is globally, not just in the U.S. And when you count funds of hedge funds, which basically another layer of fees on top of that, but they package a bunch of hedge funds for you together into a diversified portfolio of hedge funds. When you put them together, there's another couple thousand of those, so there's about 10,000 funds altogether, 8,000 hedge funds and 2,000 fund of hedge funds. And then the bars in this picture are the estimated assets under management. Actually, it says they're in billions. So 1,000, you know your math, right? 1,000 billion is a trillion. And right now there's actually over $2 trillion in hedge funds. So this has actually become a rather large industry, and actually pretty recently. In 2000, it was $500 billion. It's actually grown 4 times since 2000. So it's now a very substantial industry. It did have a falling off in 2008 with both the number of hedge funds and in their assets under management, but it's actually come back to the point where it's actually bigger than it ever was. So we have now, as I say, over $2 trillion in assets. Actually, I haven't seen, I should have looked, but the mutual fund industry, for example, has something like 15 trillion or so in assets, or 15 to 20 trillion in assets. So we're talking about well over 10% the size of the mutual fund industry, which is, of course, not a trivial industry at all. So we're talking about actually a rather large part of the investment management industry, large and really hardly existed. If you go back 20 years ago, it hardly existed at all. All right, now, I actually did a study, one of the earlier studies in this field with Stephen Brown and Will Getzman. They were both colleagues of mine. They've all been at Yale at one time or another. Will Getzman is still there. Stephen Brown is at NYU. Well, we did a study when we looked at the 89 to 95 period. What I'm really talking about today, though, is more the second study, the ABCs of hedge funds, and that is a published paper. Both of these are published papers. And the ABCs of hedge funds was published in the Financial Analyst Journal in, I guess, 2 years ago. Of course, as you know, you do a study, it's up to date at the time, and by the time it gets published, it's a little more out of date. And I figured you people wanted to see something more up to date, so we put in another couple of years of data here in the study, but it's not in the published version. So you get to see 3 more years of data, which I admit I did in a much more quick and dirty way than the original study. But just to bring this up to date, because I realize that you here are a very current crowd here, and you don't want to act like us academics who always produce something 5 years out of date or maybe more. So, all right. So, and then we're going to look at the biases of the data. There's 2 kinds of biases in this data. There's actually potentially even more biases that I'm pointing out here, but the 2 major biases in the data are survivorship bias. Survivorship bias means that that once a fund dies, closes down, it's often not in the database anymore. Now, which kind of funds tend to get closed down? Well, they could get closed down, I guess, sometimes on the positive side because they just don't want to take any more money and they're not going to report the results anymore. But much more commonly, they're closed down because they had bad results. And the way to correct for survivorship bias is pretty simple. You put the dead funds back into the database. You don't just put the live funds back into the database because the live funds have done better than the dead funds, and you put them back, and that's your correction for survivorship bias. It's not always so easy to do, though, because not all the databases actually have the dead funds back in. You have to. That's why we use the TASC database. I noticed that Vicus was using the TASC database. It's one of definitely the better databases from a historical perspective because it has all that extra information. The other bias is backfill bias. And that has to do with when a fund joins a database. When the fund joins the database, they put in their old data. You know, say you joined the database in the year 2000, and you've got 5 years of data. You give them the 5 years of data. So you give the database the data from 95 on, but you only joined the database in the year 2000. Well, again, this is an interesting question. I think you can kind of figure it out. But live action here. If a fund were to put in some old data, provide their existing data that they had, which funds are going to provide their backfilled data, and which funds are not going to provide their backfilled data? Say they all have, if you have 5 years of backfilled data, and now you're joining the new database, which kinds of funds will put the old data in? Can you imagine? Is it the funds that have the good results, or the funds that have the bad results? Well, of course, I won't ask for a show of hands, because it just, but the answer is pretty straightforward. It's the funds that have the good results tend to provide the backfill data, and the funds that have the poor results tend to actually not provide the backfill data. So it turns out that the backfill data is very biased upward, and you have to actually correct for this too. The correction for backfill data is to note when the fund joined the database. Again, that task database is a good one on a historical basis, because they give the date that they joined the database, and that means that the old data before they joined the database, that's the backfill data, and you can discard that data. So that's the two major biases, and we'll show you how big the effect is. Also, we're going to be primarily equally weighting these, but certainly another way to do everything is to cap weight it. By the way, as I may be talking, I don't think it's technical or anything, but I'm happy to have questions all the way through here. It's like I'm used to actually being a professor, where if people don't talk, I make them talk, and so I certainly welcome comments all the way through here, and it's not so much that you have to wait till the end, especially if we bring up a specific topic. You ought to ask me about it while we're on it. I can't read your name tag, so I can't really call on you. So you're safe in that regard, I guess. But in my classrooms, of course, they have big cards with their names, and I can force people to say things. All right, now let's look at this this return for these biases. Actually, if you took with the backfill and the live only, that's the very first row there, and that 14.88%. If you did no corrections for the biases at all, you would say hedge funds had a return of 14.88% over this period from 95 to 2009. And by the way, I mistyped this. The actual number here shouldn't be 4%. And I shouldn't necessarily be highlighting that second row. The full effect of the two biases here is actually going from row 1 to row 4. And you can see that going from row 1 to row 4 is actually about a 7% bias. So you've got these two biases, and they actually take that number, the hedge fund return, from 1488 to 770. And so these are non-trivial biases. In fact, each one of them is roughly about the same order of magnitude. As I say, the way you correct for the survivorship bias is you put the dead ones in. So depending on, if you're just using the backfill data, it would have been about a 3% comparing row 1 with 2. But if you're doing the backfill, then you might compare 3 and 4, and that's about a 5%. So say 3 to 5% survivorship bias here per year, but then we have the backfill bias, and you might compare rows 1 and 2 with rows 3 and 4, and the more relevant ones would be comparing 4 with 2, and there's about a 4% backfill bias. So you've got roughly about a 4% backfill bias and a 4% survivorship bias, and they sum up to about a 7% difference. Yes. That's a very good point, and that's like a selection bias, and I would like to account for that, but those are harder to find out about, you know. But yes, there's still a bias, as you point out, because you don't. Well, but I will say they do join the database on a forward basis. I guess why would they not want to join the database? Most of them. They don't. There's lots of different databases, but they're only in some of the databases. However, that's not as big of a bias because everybody who's running funds at least thinks they're going to do well in the future, which you're talking about. But there can be a selection bias like you're talking about. If you think you've got pretty bad results coming in the future, you say, well, why don't I wait to join the database until we get our organization a little bit more put together? Yes, Vikas. You can help me out?
Which actually are more than $100 million of long equity positions, they have to report to 13F. So we look at the 13F and compare it with the TAS database, and we figure out how much is the selection bias. And so we actually really didn't find it. So that would, you know, at least that shows that it's not big enough so to worry about here.
I appreciate that, Vikas. Actually, I have to admit, Vikas has done more research on the hedge fund industry than I have. So I would defer to him on this, especially since you said it has no effect. All right. Now, in the end here, we end up with this. That number 7.7 is the number we're going to be using throughout the rest of the study. It's not a bad number, though. It looks like, well, we went from 14 to 7. That's a pretty big cut. But it's not really going to be all that bad. It's true it's a little less than the S&P 500 over the period, which was a little over 8%, but it's in the same ballpark. So you'll see that 7.7 show up on a lot of different slides. But now, on a value, we're doing all this study on a equally weighted basis, but on a value-weighted basis, you'd get different numbers. The 7.7 is not going to show up here because we don't have all the sizes of these funds. So when you do a value-weighted set of numbers, you're doing with a much more limited sample, and it's another reason to do the equally weighted because you have more funds to work with. But the value-weighted, interestingly enough, the value-weighted counts actually turn out to be a little better performance than the equally weighted. That is, the bigger funds seem to do better than the smaller funds. This is an area that's actually had quite a bit of a research where there's some studies show the smaller funds do better, there's some funds that show the bigger funds do better, but on this value-weighted count, it actually seems to show that the bigger funds do better. That's partly because there's a lot of quite small hedge funds that really don't do very well at all. But it's probably still true that as a fund gets bigger, it's harder and harder to actually get the great performance. I'll say one thing, it's these small funds that have the big backfill bias, not so much the big funds. The big funds aren't affected by so you look at the value weighted, there's really no impact on backfill bias. But the small funds you can see in this sample have about a 3% difference between rows 1 and 4 between the equally weighted, which are really capturing more of the small funds. And those are the ones that have the backfill bias. The big funds have been around pretty much most of them since the database even started. Or at least the period we're studying even started. All right, so now we've talked about these biases. They're really strong, but now we've corrected for them. So now we can actually check out how they're doing. The first thing you might ask is, can hedge funds be replicated? There now numerous attempts, numerous ways that you can buy replication of hedge funds rather than actually buy the hedge funds themselves. If you capture a lot of the impacts of the hedge funds, like sensitivities to momentum or sensitivities to value that they may buy, you can buy combinations that seem to replicate the hedge funds. And basically, though, what you're buying is a package of betas that are similar to the betas inherent in the hedge funds. The part that you can't replicate is the alpha, because you're replicating with a set of betas, a package of betas, basically, but you're on the other side, though, is you can't replicate the alpha because that set of betas doesn't give you an alpha. Now, why would you want to replicate these? Why do you think people are interested in these replication funds? That's the answer, right. Replication funds are basically a package of betas that you can buy them quite cheaply. Hedge funds, the median hedge fund fee is 1.5 and 20, but various replication funds you can get for often without the incentive fee and maybe 1%. It depends on, or it could be lower, you know. So there's plenty of incentive to try to replicate it. But if there's an alpha here, you're going to be missing out on that. Now, what about, we'll look at these returns after the fees. We'll see what part comes from beta, what part comes from alpha, and then look at some of the year-by-year returns with the alphas and their betas. Am I going in the wrong direction? Oh, I'm holding this upside down. All right. Now we'll look at, I just put some of the categories up. Equity market neutral, long short equity, fixed income arbitrage, and global macro. And what their betas were relative to the beta on stocks, the beta on bonds, the beta on cash. In this study, we have lots more potential betas in there, but these are the key ones. And one thing, and then the overall index of the whole equally weighted set of all hedge funds. Well, interesting thing here. I guess, first of all, the most important thing that comes out of this is that alpha. That alpha is 3% a year, at least over this period. I'll show you the more updated data, which brings it down a bit. But over this period, the alpha is 3% a year. This is after fees. So that's actually quite an achievement, because you know, after that 1.5 and 20, you actually have to have quite good returns in order to cover to get an alpha after fees. Now, there is a beta in these hedge funds. That's why you might want to replicate them. You can see the beta on stocks on average is 0.34 across all hedge funds, but long short equity is more like 0.5. A beta of 0.5 on long short equity. But across all hedge funds, it's 0.34. There's usually a negative beta on bonds. Of course, it doesn't matter that there's a beta on cash. You want there to be a beta on cash. You want them to, ideally, if they're hedged, that's what you'd like it to be, all the beta on cash, but not on stocks and bonds. So there's that 7.7% that I talked about before. It's not the 14.8 that we started with before we removed the biases. But even as we took it down to the 7.7, we end up with a 3% alpha. So this is why that industry's grown so much. Actually, an industry that actually can produce alpha. If you go to the mutual fund industry, there have been hundreds of studies over the years on mutual funds, and their alpha is basically roughly 0 before fees and negative after fees. So mutual funds have not delivered the alpha. The fees are much lower than hedge funds, but they have not delivered this alpha. So here we actually do have this pretty remarkable alpha being discovered. So, and they're usually statistically significant in most of the categories. So this is all kind of good news for hedge funds. The betas are relatively low, although ideally you'd like them to be 0 on stocks and bonds. I guess you don't mind the negative number on bonds, but you would prefer to get a 0-1 on stocks. If they have the low betas or low or negative betas will make them good diversifiers. All right, now we're going to put them all the sources, the ABCs here. We're going to that 3%, that 7.7 still shows up here that we talked about after we removed the biases. The 3% alpha. The rest of that is actually beta return. So the beta return is not trivial. It actually becomes, it's actually bigger than the alpha return. And now you want to gross it up. And I'll admit here we didn't really have the data to gross this up because all the data is reported in net returns and you only have a smattering of gross returns to gross it up. So the way we did have enough data to say that the median fee structure was 1.5 and 20. So we took that median fee structure and grossed it up. And that's how we got the 11% here as the gross return. Now, I guess I was so motivated to do that because I love that title, ABCs of hedge funds. You got the alphas and the betas, you got to get the costs in there. So I put it in, even had to force it a little bit, but I think it's a pretty good measure of what the costs are. So if you put that 1.5 and 20 estimates in here, you get you can see that fees are actually bigger than alphas too. The alpha that's being created by the hedge fund industry, more than half of it goes to the managers of the funds. Because you got two alphas here. If a gross alpha is going to take that 3.43 and that 3%, add them together, and you get about a 6.4% gross alpha. Well, the gross alpha then is divided up between the customer and the manager actually takes the bigger piece of it in the end. Now, of course, you probably are familiar with many hedge fund managers, some of whom are very rich. I don't include myself quite in that category yet. I mean, I admit we made some money when I sold my other company, the Morningstar, but in the it's the funds that actually got over $1 billion and so forth. You get into this huge economy of scale here, and when they're getting the alpha here, more than half of the gross alpha, you can see what a tremendous source of wealth it might be for some very rich individuals, I guess. Some of them are in Boston, of course. You may know them. All right. And of course, you all want to get into that industry because you can see that alpha basically goes to the people who work in that industry. Maybe not your first year on the job, but potentially if you actually get to be one of the partners or whatever of the hedge fund, that big piece is going to those partners of the hedge fund. So that's why I'm not saying you're greedy in this room, but that's what might motivate some of you for being here today. That such a big piece actually goes to the operators of the hedge funds. I will say though, well, we'll talk about this in the panel afterwards, I'm sure, but not everybody, you have to get to a certain scale to really make that, to get a big piece of that. All right, now, what about asset allocation with these hedge funds? I'm comparing it here with the Russell 3000 index in yellow. We've got the two sources here. Here we update everything. So the ABCs of hedge funds is the published article. The last piece is just taking some HFRI data in there and doing a more quick and dirty study and updating the hedge fund piece of this for the last 3 years. Now that 7.7 number is gone away because we have 3 more years to add to it. But the annualized returns of hedge funds, 6.92%, less than the Russell 3000 of 8.64. And of course you can see the line graph. Russell 3000 did better than the hedge fund index. So this might make you think, well, hedge funds have been disappointing. But that's not my conclusion at all here. The standard deviation is about half as much in hedge funds. They really do hedge, actually. They have long and short positions, and they really do hedge. They actually have relatively low correlations, too. We'll talk about that. So they actually improve the portfolio. If you look at the ratio of the return to standard deviation, the return to risk, the hedge funds have much higher return to risk than does the stock market. The beta in the stock market is, of course, 1. The beta of the hedge fund on the stock market is 0.35. And after you put the new 3 years of data in, the alpha's dropped now. It's 2.5 instead of the 3 we had before. But, of course, the alpha on the whole stock market is 0. So the fact that you actually can get alpha here is pretty remarkable. Even after the high fees. And here are the yearly returns. First of all, the raw returns in blue. And these are adjusted for survivorship bias. I didn't actually have to adjust those last HFR returns for survivorship bias because by now most funds and backfill bias, by now most of the indices have finally cleaned that kind of stuff out, and you can actually don't have to worry about it in real time here. But in the old data, most of those indices are not appropriate anymore. You really do have to make all the adjustments, but not in current time. Now, here's where we split it into alphas and betas. The alphas are in green, I guess that is, and the beta part is in orange or mustard color, I guess. And you'll note that, well, first of all, let's go back to the return side. There's only 3 years on the return side since '98 that the returns were negative on hedge funds. When you look at the alphas in green here, there's really only 2 years where they had a negative alpha. And in particular of interest is in the year 2008. In the year 2008, of course, that was, even you all remember, you're young here, but even all of you remember 2008 as the financial crisis here. Stocks dropped a lot. They dropped actually 40% that year. But hedge funds went down too. However, they actually had a positive alpha in 2008. So the reason why they had a negative return in 2008 was because they had that they had a beta attached to it. They rode down with the market. In fact, the beta was relatively high in 2008. So now let's take these two parts and separate the alphas and the betas. These are the alpha returns in green on the left. And there's only 2 negative years. One of them in '98, one of them in 2011, pretty recently. Actually, 2012 is a positive number, but it's so small it doesn't even show up there. It's basically 0 in 2012. So we're actually coming off of 2 pretty bad years for hedge funds. I mean, one of the negative ones and a 0 basically. And if you actually run a regression through those lines, there's indications here that the alphas that hedge funds provide are dropping. They're not, it's difficult to get that kind of an alpha with an industry this big. It's much easier to get that kind of an alpha in a small industry than in a big industry. So the alpha is dropping, but it seems to be still positive. These are the beta returns. You can see, again, usually we've had a positive beta, so they just track the market, but they lessen the impact of the market. Roughly, again, an average of 0.35 beta, but it changes year to year. And the big drop is 2008, when the beta was actually pretty high. So in 2008, you had that big drop, a big beta return, basically, too much beta in the stock market, in the hedge funds, but a positive alpha in 2008. So alpha is a pretty remarkable record for hedge funds that they actually have produced is after fees, these kind of positive alphas. The bad news, though, is the correlation of hedge funds here with the stock market, but with in general is rising amongst each other and with the stock market. So hedge funds are getting more like each other, and they are basically getting more correlated to the stock market. The beta, in fact, is basically going up with the stock market. And the relation to the stock, they're getting less like hedge funds and more like the rest of the market here, which is actually kind of troubling because you want to buy the alpha, really. That's what you really want from these hedge funds. If you just want the beta of the hedge funds, you can get that from replication funds. Or you can get it from buying the stock and bond markets even. Okay, now what if we want to put this together in terms of asset allocation? What you really want from a hedge fund is you want you want to get alpha and you want to get diversification. Those are the two things you really want, because you've got other things in your portfolio you want to mix it with. And this is what you'd like to get from that hedge fund. So, and this is an optimization that was in here where we just put in some numbers, and we put the stock market, we put the stock markets in that kind of chartreuse, I guess. The bond market is in blue, cash is in purple, and hedge funds are in red, and we can make combinations of these and optimize portfolios in order to put together an asset allocation mix for investors. And when you do the combinations, well, it depends on the level of risk here. So this is the level of risk, and then those all add up to 100. So for low-risk portfolios, you want to hold, actually, mostly what you hold in a low-risk portfolio is cash and bonds, but you also, hedge funds fit in very well there because they're diversifying the rest of the portfolio. As you get more, to more and more higher risk portfolios, the only way you're going to get that extra return is in the stock market. You won't get it typically from hedge funds, although you could if you bought a very equitized type of hedge funds. So as you get higher risk portfolios, you cut your bond allocations, you cut your hedge fund allocations. But the interesting thing here is that these hedge funds do fit into portfolios here because they do provide that diversification. They actually, the red piece here, depending on what risk position you're taking here, basically has up to 40% of your portfolio at least could be in hedge funds, but typically more like 10 to 20% of the portfolio might be in hedge funds, and so it's clearly a way that helps you put together an asset allocation. If we put different numbers in here, of course, anything could change here. And actually, I do run a fund. This is a kind of an academic speech, and it's based on actual papers that are published. So I didn't put Zebra's name anywhere in there in this fund, except on this slides. I put them up here and there, I guess. But I'll let you in on a little secret. Fund Z is a Zebra fund. It's our zero beta. It's not Fund A, it's Fund Z for a reason here. But our fund, the purpose of the Zebra fund actually is to have a zero beta fund. That's not correlated with other assets. And that, so if it's a zero beta fund, all of its return actually then is alpha. And that's the notion here. You really would like to pay for alpha, not for beta, because there's so much cheaper ways to get the beta. You can even get it with index funds. So you'd like to pay for the alpha, not for the beta. And the cleanest way actually to do that is to buy funds that actually have low or zero betas. And this shows up in the correlation structure. So the fund Z here is actually the first column and the first row. You can see that going down the first column, fund Z is not very correlated with the market, the stock markets, and not really correlated with the bond markets, or not even very correlated with the hedge fund composite index. That's what it's trying to do, is really be that diversifier and really provide the pure alpha and not the beta. Actually, the bottom row here, or column 7, is the composite hedge fund. And the composite set, ideally you want hedge funds to have those zero correlations. You can see that they actually have very high correlations with the market. The betas may be low, but a lot of their correlation is still high. They're actually extremely correlated with the stock market, 0.89, or there's say the Russell 1000 or the Russell 2000. They're extremely correlated with both of those. They're extremely correlated with the MSCI World Index. In all these cases, those correlations are about 0.9 with the index. So generally, hedge funds have not been providing one of the key things that they're supposed to be providing is that real diversification, because their correlations are so high with the stock markets. They're not high with the bond markets, but they are high with the stock markets. So you ideally would want to buy your hedge funds without all that correlation, because you have to pay 1.5 and 20 for that, or it varies. Some hedge funds even much more. All right, here's a few conclusions, and adding dead funds and excluding backfill that's where you knock out most of the biases here. And according to Vickus here, it was almost all the biases you can knock out by adding these two pieces here. We knocked down the return from basically 14 to 7 or so, and 14.8, I guess, is 7.7 or so by excluding those biases. But even after we removed all those biases, and even after we put the updated data in here, the alphas are still positive. After all the fees, after all the biases, there's still been a 2.5% return over the periods 95 through the present. And however, betas and fees do represent a big part of the return. They're bigger than the alpha part. So the beta part is bigger than the alpha part, and the fees are a bigger part than the net alpha part that you're getting. And but the good news is, though, they have delivered that alpha rather consistently, 13 out of those 15 years, and even in 2008. And finally, asset allocation, hedge funds are potentially excellent diversifiers. They're not perfect in any sense because of their high correlations, but the bad news is they have delivered, but the alphas are dropping and the correlations have been increasing. And I know we have the panel starting in just a couple of minutes, so I will take just a couple questions here before we, yes? Okay, why don't you, just so everybody can hear that one, repeat the summary version of that.
Yeah, back to the slide where you extrapolated that alpha data in terms of the alpha returns, and in 2008 we saw a positive return. Do you happen to know what percentage of that would sort of be from those hedge funds that had abnormally large positive returns in 2008? For example, John Paulson sort of betting against the subprime market.
Well, we have so many hedge funds in the sample. We have thousands of hedge funds in the sample. So anything you're looking at here is not dominated by a few big hedge funds. It's basically saying across the thousands of funds here, we actually did have that positive alpha. Unfortunately, they had so much beta that year as well. So they did end up with a negative return in 2008. Here's the question here.
I guess in your Z fund, what is the principal way that you eliminate beta? Do you have a main strategy?
Actually, it's an equity fund. So our Z fund, which is actually the Zebra Global Equity Fund Beta Neutral Fund. Okay. The way we eliminate it is you have long and short beta, which cancel each other out. It turns out that our strategy buys the less popular stocks. They end up with you buy the low beta stocks, you short the high beta stocks, but you have to be then net long. So we're roughly around 150, 100. You have 150 long of low beta, roughly 100 short of high beta stocks, and then so it's carefully managed, so whatever that ratio is, to knock out the beta. And so at all times the fund is managed to be that basically zero beta fund, which you might think is all of us should do, but actually the zero beta funds make up a trivial part of the universe. That's why you should all buy my fund. However, we're looking for maybe bigger pieces than you might offer in this room here, because we have $1 million minimum, which is even more than your tuition.
Thank you.
Yes. You want to get the mic over to you?
Thanks. In regards to the alpha compression you were talking about earlier, where do you think that's coming from? Is it from a product standpoint where you have all these funds entering the space and hugging the benchmark and strategies becoming commoditized, or is it from an investment standpoint where you have like macro risks correlating markets that weren't correlated before?
I would say the alpha compression, it has to do with the fact that we have over $2 trillion in this industry, and when we started measuring it, it had less than, back in 2000, it had only $500 billion in the industry. It's very hard to get alpha. One of the things you've probably learned in your classes and so forth is that alpha is a zero-sum game. For every positive alpha, there has to be a negative alpha somewhere in the system. They sum up to zero. It's like playing poker. Poker is a zero-sum game. For everybody if we all, it'd be a big poker game, but if we all played in one big poker game here, we'd have to, the winners would equal the losers here. You don't walk away from the poker table richer, everybody. You know, we all, actually, after some costs, you all walk away a little poorer. But basically, that's that zero-sum game. Alpha is a zero-sum game. In order to have if you have a big industry with a positive alpha, there's got to be some other group that has a negative alpha. One thing that's been identified in the academic literature is the individual investors. They tend to make pretty poor decisions, and they tend to have negative alphas. But in general, to get that positive alpha, you need the negative alpha. And once an industry gets really large, it's harder and harder to extract that negative alpha from another part of the investment universe.
Thank you.
Okay, I guess we're going to have our panel next, so I'll stop here. Thank you.